Good evening, class. Today we are going to learn about the accounting cycle. And in this accounting cycle, it generally means the accepted definition of accounting cycle means that accounting cycle, which refers to series of the stages necessary to produce financial reports. The stages are identifying of transactions, measuring of I've shared the screen. So accounting cycle, which refers to series of the stages necessary to produce the financial reports. And the stages are identifying of transactions, measuring of economic changes, recording of transaction in the relevant books, communicating of financial information associated with economic events. Please note that the objective of the accounting system is to produce financial reports about the organization. Accounting concepts and conventions. There are 7 basic concepts or principles in accounting, modified by 3 conventions which have been adopted as a general guide to practice. The business entity, that's the first one. In this, these concepts suggest that the business is separate from the owner. Therefore, all accounts are kept in respect of the business entities, which are distinct from persons who own or manage them. It then follows that the personal financial affairs of the owners are never intermingled with those of the business for which the accounting is being performed. Money as a common unit of account. In this concept speaks to the fact that accounts are expressed in monetary terms which can be added or subtracted. This gives a meaningful financial description. The implication of this concept is that any information that cannot be measured in naira terms, such as the quality and experience of workers, is usually not included in the financial statements. So the next slide. The cost concept. The historical cost concept, as this may be called, says that the asset resources required by a business are reflected at cost, which means that for their subsequent treatment in the measurement of the income of the business, the price paid on such acquisitions form the basis instead of their real or market values. The going concern concept. This concept assumes that the business will continue operations for the foreseeable future. That is, it has no plans to either liquidate or cut down significantly any major line of its operation in the nearest future. The accrual concept. The concept accumulates all revenues and expenses to be received or judged in a given accounting period, irrespective of what is actually received or paid. The concept of duality. The duality concept determines that the financial situation of the enterprise be represented in terms of the basic accounting equation. Thus, it recognizes that each transaction involves 2 entities in the same set of accounts. That is, every credit must have a corresponding debit and vice versa. This will be written in details under double entry system. The realization concept. The realization concept assumes that the revenues is earned on the day which is realized, and that is when goods are transferred to the customer in exchange for valuable consideration. accounting convention. You will recall that we say that there are three conventions which guide the application of the concept in practice, and they are as follows. Comfort, Conservatism or prudence. Here, the profit is understated while all possible losses are anticipated and taken into books. All possible future profits will be ignored. Consistency. There should be consistency in the use of a particular accounting method for reasonable periods of time so that comparison between accounting periods will be meaningful. Material, materiality. The size of an amount will influence its treatment in the books of account depending on individual entities. Therefore, what may be considered material in any circumstance is judgmental. And that's the end of our lesson. Thank you for your cooperation.
Thank you, Mwalimu.
Thank you.